So I guess let's take that apart a little bit in that, how do you value a REIT? You were talking about the NAV value, and that's what a lot of analysts use. And I think you've established that that's probably wrong. So how do we value a REIT?
Sure. Well, NAV is useful in the sense that, REITs are unique in that they're asset based. So when you buy a REIT stock, if you know the NAV, that's almost your downside, right? I mean, it's like the breakup value of a company, which it could be broken up into assets. Whereas you wouldn't know that with almost any other business, which is what makes REITs. It's one of the many things that makes REITs a very safe investment. But when you're buying into a real estate investment trust, I tend to look at, when I'm stacking REITs up against one another, I tend to sort of take the approach that I would do in the book. And there's an analysis of Store Capital, in fact, from 2014 to 2019, and just walks you through the financial model of Store and how it worked. And ultimately, it comes down to, with all great businesses, the idea of wealth creation is to make the company worth more than it costs to create. You guys are probably familiar with the notion of economic value added, which is a construct done by Stern Stewart and company. But I tend to focus really not on EVA, but on what I would call EMVA, equity market value added. So I don't really care as a leader or even as an investor. I don't really care about the cost of capital. I care about the ability to make the equity worth more than it costs. And by the way, very few businesses in the world rise to this level. I mean, the people that are in the Forbes 400 all created businesses that are worth substantially more than they cost to create. So when I'm looking at a real estate investment trust, I'm stringing together typically three numbers. One is the dividend yield. Everybody knows what the dividend yield is. The second is, what is the internal growth rate? So that the internal growth is sort of the number a REIT can generate without raising a nickel worth of new equity. So it comes from rent growth, and it comes from reinvesting the free cash flow. So getting that compounding. And then the third component is external growth, which is the amount that the REIT could generate by raising new stock. And so I'm stringing together those three numbers. So if you have dividend plus internal growth plus external growth, then you get to expected total rate of return. And when you get expected total rate of return, then you're looking at all the REITs, and you're lining them up, and you're going for the ones that have the best expected total rate of return. Right. And I would say that leverage matters, and there's some risks to it, and there are probably some qualitative issues to it. But Store is only 40% levered on cost, so there's just not a lot of risk in the sense of 40% leverage on real estate is pretty low.
Yeah, it's very low. That's very low.
Would you say within the different commercial real estate types, is there? I mean, you're talking about, the price you pay obviously matters a lot, but do you think there's a type of commercial real estate that might be economically more advantaged than others, or does it just really depend?
No, I think so. People would ask me every now and then, well, how's the REIT industry doing? Which is sort of like asking you, how's the C Corp industry doing, guys? It's a tax election, right? And so you've got REITs that are doing everything from cell towers to billboards to apartments. They're in fundamentally different businesses. And you're analyzing these companies. You can get a lot of diversity in a REIT portfolio, of course, because even though they're dividend stocks, it's not an industry per se. These are all parts of lots of different industries and lots of different business models. In the case of the net lease sector, which I was familiar with, it has different characteristics from others. So you start off with the sales to business investment ratio, which in REIT parlance is pretty simple because it's like cap rate, So in the case of Store, our yield was 8%. And in the value equation, then what you do is you take your 8% and you multiply that by an operating profit margin, which is a cash flow margin. So what you got to do is back away all your non-cash depreciation, amortization, and you got to ignore all the stock-based compensation too. So you're just getting down to a cash operating margin. And in the case of net lease companies, what's amazing is that the cash operating margin is huge. I think it's huge. Kind of average around 94%, something like that. So the sales to investment ratio is not that exciting. It's not going to light you on fire compared to a Google or something like that. But the operating profit margin looks pretty sweet. And then you factor into it the percentage you're funded with OPM. Store is basically 40% funded with debt, 60% with equity, and the cost of that OPM. So I don't know, I think Store's cost of OPM today is probably kind of in the high threes or something like that, maybe 4%. And then you subtract out the maintenance CapEx. You include that as the last variable. And net lease companies have almost no maintenance CapEx, right? And then if I'm looking at multifamily, or let's say I'm looking at offices or shopping malls, they have far more people, far more costs. So their operating profit margins are going to be less. They're going to have more CapEx associated with them because they have a lot more maintenance CapEx. And so the business models are just going to be different. So you have to stack up the business models against each other. If you're a value investor, I tend to be a value investor, you focus on those REITs that are going to be delivering you the highest rates of return.
The thing I can't figure out too is some of those categories you talked about with the higher CapEx, their cap rates were lower too. And I'm kind of scratching my head like, why are the cap rates so low and people are buying into those when there's other alternatives with higher cap rates and higher margins?
And it's because people don't focus on business models. They oftentimes just focus on NAV. I mean, you get down to, so office buildings trade at a certain NAV. One of the things, I remember we went public in STORE in November of 2014. And the day after that, there was our IPO was something like $560 million. The day after that, the largest REIT IPO of the year happened, and it was over $2 billion. And it was an office REIT out of New York, and it dealt with Class A offices. And we were doing chicken stores and veterinary clinics or whatever, and they own Class A offices. So from a cap rate perspective, they traded differently than we did, much higher multiple because of perceived quality of the real estate, the institutional quality of the real estate. When REITs go public, they have to do they do the filing, and they have to do what's called a magic page. And people spend forever calculating these magic pages, but basically magic page is giving you sort of an annualized free cash flow for this distributable to investors. And so in this case, when you looked at their magic page, you saw how much in CapEx they had to make just to kind of keep up their buildings, which typically you wouldn't see in a public disclosure anywhere. And when you did that, you realize that even though they were a much more highly valued company than we were and a bigger company than we were, their free cash flow was about the same as ours. And so then when you looked at a ratio like funded debt to EBITDA, which people will look at as a risk ratio for debt, to think about leverage, our ratios there were similar, but if you said funded debt to free cash flow, then we looked like we had half the leverage they did, because people didn't focus on the free cash flow piece of it because of the CapEx. So people miss some of that, and that's important.